I think it is going to get a little momentum. And why is that? It's because, as Jim pointed out on air, that the Fed has managed to hike and the world hasn't fallen apart. And so that indicates that the Fed hiking and the Fed hiking some more in the future is not going to bring the world to an end. We also pay attention to the fact that the Eurozone is doing exactly the opposite thing. They're still trying to lower interest rates, and that's great for the dollar.
Okay, what you said was that we had a rate hike and the market didn't fall apart. Bringing on Peter Schiff in just a moment. He has come on this show multiple times and told us all that the Fed actually would never be able to raise rates. Take a listen.
Everybody is still fooled by the Fed. They still believe that the Fed is serious about raising interest rates as if they can actually do it. Even if the Fed wanted to, they can't, not unless they're willing to put the economy through a protracted recession and a worse financial crisis than 2008, which is exactly what they should do. They should have done it in 2008, but they didn't, so they're not going to do it now. I do think gold can have a nice rally by the end of the year because I don't expect the Fed to raise rates in December.
Peter Schiff is joining us on satellite. Peter, welcome. Your reaction. The Fed did raise rates. Scott Nations, question for Peter. I know you're just chomping to get in here.
Well, Peter, my question is, if Fed Presidents Lockhart and Bullard, who this week and last week came out and said that they were actually in favor of a Fed rate increase, are speaking for at least some members of the Open Market Committee, why is it that you are so certain? What's the data that says that the Fed won't increase rates in either October or December?
You know, well, it's possible that these dissenting opinions maybe are genuine, or maybe they're just out there as part of the show, you know, part of the bluff to create this theater like there's some kind of tension at the Fed. You know, it's open mouth operations, but look at all the data points. I'm not making this stuff up. Look at all the numbers that keep coming out. I'm not talking about just the ones from today, but look at the manufacturing numbers, look at the ISM numbers, look at industrial production numbers, even look at the consumer spending numbers, confidence numbers. Everything is going down despite 0% interest rates. All we've got for the Fed to hang its hat on are these phony employment numbers. Yes, we have a low unemployment rate. Big deal. Nobody's looking for work. They've all left the labor force. They've all settled for part-time jobs. Look at the home ownership rate at the lowest it's been since 1967, and that's only because old people still own their homes. Look at the home ownership rate among people in their 20s, 30s, 40s. We've never seen anything this low. Meanwhile, rents keep going up. Consumers have no purchasing power. They have lousy jobs. They're drowning in debt. This economy is a disaster thanks to the Fed.
Our economy...
Peter, there...
Go ahead, Scott.
Well, Peter, there you go again. Because the most important... everybody agrees, except for you, evidently, that the most important data point and the data point that the Fed is focusing on is jobs and the unemployment picture. And so I can understand why you want to discount that, try to explain it away, but that's what the Fed is looking at. And we also know that Janet Yellen's favorite personal data point is the JOLTS, the job openings number. And unemployment, the unemployment rate and the JOLTS data have actually been very good. And Lockhart and Bullard both spoke to that. So how can you explain away the one piece of data that's most important, but that disagrees with your point of view?
Well, Scott, those numbers have been superficially good for years, yet the Fed hasn't moved. I think they know that it's only superficial. Look, if you look at the real unemployment numbers or what's going on in the job market is destroyed. You have all these part-time jobs, service sector jobs. We've lost good jobs. We have the lowest labor force participation rate since the mid-1970s. This is not a healthy jobs market, and employment is a lagging indicator, not a leading indicator. People don't lay off in advance of a recession. They start firing people as a result of a recession. So by the time you start to see the jobs data really, falling off, it's too late. We're already in recession. The recession may have already started. Remember, the Great Recession of 2008 started.
It's never been better.
Let me shift
the unemployment rate has not been better in a decade.
Peter?
But look at the labor force participation rate. Look at the number of people working part-time. And a lot of these jobs that have been created don't really exist. The government makes them up in the birth death
Gentlemen, just for a second. I think we're losing a little bit of focus here because we're really getting into the weeds on the data. Yes, Janet Yellen has said that the Fed is data dependent and what matters is what is happening here in the United States. But during this last press conference and during that statement that was, where we did not get the rate hike that we were expecting, she also also mentioned the global economy, and that was really the first time that she did. The Fed is really worried about what's happening in China. If that subsides somewhat, it could potentially set the table for that rate hike to come, and it may not be in 2016. It could still be 2015, rather. It could be early next year.
That is not what the Fed is worried about. I've always said they're going to look for an excuse
so is the
not
Fed
to raise
lying
rates.
To us
So
about what they're worried about, Peter?
Yes, look, they could be worried about a lot of things, but they have no intention of raising rates. And so they have to come up with an excuse that's palatable. They can't tell the truth. We can't raise rates because the U.S. economy is a disaster. We've inflated a bubble and we can't raise rates. I said this 7 years ago when they lowered interest rates to zero. I said this was a huge mistake. They're stuck. They're in a monetary roach motel. They're never going to be able to raise rates back up because the easy part is cutting rates to zero. The impossible part is lifting them back up again. We can't do that because this economy is more addicted than ever before to cheap money.
Peter, it's Anthony Grisanti over at the Merc. All right, so say everything is exactly what you said. We have 0% rates. We're looking for maybe another QE4. How do you fix this? That's the question I want to ask. How do you fix this economy? How do we get off zero rates? How do we not have QE? Go ahead.
That's a good question. See, eventually, the foreign exchange markets are going to get wise to the Fed's con. They're going to figure this game out, and they're going to realize that the Fed is never going to deliver on this promise, that rates aren't going to go up, that the balance sheet is never going to shrink, that it's going to grow in perpetuity, and then there's going to be a currency crisis. This dollar rally is going to reverse. The dollar is going to sell off. It's going to take the bond market with it. It's going to put tremendous upward pressure on consumer prices. The Fed is not going to be able to pretend there's no inflation, and then their back is going to be to a wall. They're going to have to raise rates or destroy the dollar completely, and that's when rates are going to go up. But it's going to hurt a lot more because the Fed wouldn't have acted to preempt a crisis. They will act in response to a crisis. But if they did do the right thing now, and if they did raise rates, unfortunately, we will have a worse financial crisis than the one we had in 2008. I am not happy about that, but this is the reality. This is what the Fed did. They created the last crisis, and then they refused to let the market restore balance and solve the problems that they created. We kicked the can down the road. Now we've run out of road. The can's too big. We can't kick it anymore. We're going to have to deal with this reality.
Peter, you're describing a very dovish Fed scenario here, that they can never raise rates and they have to prop this economy up. Let's assume that you're
No.
correct.
They don't have to.
Let's assume that that's correct.
They should let this.
Then why isn't gold rallying? You've long been a champion of gold, and it's stuck here just over 1,100. Gold's doing nothing. A dovish Fed is good for gold.
Because most people think like Scott. They don't think like me. Most people believe the Fed. They think the Fed's going to raise rates. They believe Yellen, just the way they believe Greenspan. You know, in the late 1990s, there's a bubble in the dollar, and so gold is depressed as people are looking for tighter monetary policy at the Fed, which would really be unprecedented. If Janet Yellen actually shrunk the balance sheet like she's pretending she's going to do, there's no precedent for that. We've never had that at the Fed. They always expand the money supply. They don't contract it. They don't start selling treasury. So the market is bracing for this. The emerging markets are bracing for this. Commodities are selling off. The whole world has been fooled by this Fed
Okay, so the whole market is bracing for
they're going to wake up.
The whole market is bracing for this, and you're still willing to sit there and say Janet Yellen is lying, and the whole market is believing it, and you're the only one that has it right?
I'm not the only one, right? I'm certainly in the minority, but the most people have it wrong. And this is not the first time that I've been against the consensus, and it's not going to be the last. And I'm usually right. You know, and generally when everybody believes one thing, they're usually wrong. You know, people get trapped in this bubble and they can't see it because they're trapped inside it. And this is a big bubble, and the bigger it is, the more people get taken in by it.
Okay.
Peter, you did a wonderful job of deflecting Jackie's question about gold, because you told a bunch of people to buy gold at 1,700. You told them to double up at 1,225. Here, the S&P is down 35 handles today, and gold is down $8. And where is it at now? Well, it's at 1124 right now. So my question is, you say that everybody thought that the Federal Reserve would raise rates. And again, if price is truth, and we can look at a chart of the Fed funds futures for the entire year of 2015, this shows that it wasn't until the September meeting, that we really had an opportunity, at least as far as the market was concerned, to actually increase interest rates. Prior to the September meeting, the market was absolutely certain that an increase was not going to happen. So you're certainly welcome to your own opinion. You're not welcome to your own facts that everybody counted on a
Scott,
rate increase before September. So how about this? Let's either revise history or convince us about the future, but let's not do both at the same time.
All right, first of all, the last time I was on the show, it was well before September, and you were saying everybody thinks the Fed is going to raise rates by the end of the year. And this was way before September, and I said everybody was wrong. And look, when the year began, everybody was divided between will the Fed move in March or will they move in June?
Peter,
I said they won't move at all. Everybody has been looking for a rate increase. Yes, I was on this show a couple of months ago.
You're declaring victory in the middle of the seventh inning. And let's remember, you said there'd be QE4. The Fed not raising rates in September does not mean you were right.
I didn't. Scott, let Peter respond. Peter, I do have to wrap this segment up. So final word to you, and then we'll move on.
I didn't say there'd be QE4 before September. I just said I didn't think the Fed was going to raise rates in September or any time this year. And Scott said I was crazy for saying something so outlandish. And yes, I've been telling people to buy gold since it was under 300.
QE4.
No, go back and listen to what you said. But no, well, but I was telling people to buy gold when it was under 300, and it's still over 1,100. Gold has outperformed the U.S. stock market since I made that call. Yes, gold is off the highs. So is the stock market. Gold is down less than the stock market today. I still think it's going a lot higher. And probably Scott's not going to buy any of it. But you better go back and look at what you and I said months before September. You were 100% certain the Fed was going to raise rates by the end of the year. And you're probably wrong.
In September.
They didn't raise in
next
September.
time,
you were 100% certain there'd be QE4.
Next
you were 100% certain that there'd be QE4.
Not this year.
Next time we have
not
Peter
this year.
on,
And Scott,
we will have tape.
I predicted QE3, QE2, and QE1. Where were you, Scott?
Peter, I apologize, but we really do have to go move on, get to the trade. Great having you on the show. We will have you back on again.
Independent raise interest rates anyway. This is all to try to pretend the economy is much stronger than it is. But all of this is going to come back to haunt the Fed in 2016 when they have to deal with the consequences of this. And I think they're going to look a lot more foolish having raised rates and then having to reduce them than had they left them at zero the whole time. But of course, all of this is wrong monetary policy. Interest rates need to go up. They need to go a lot higher. And it shouldn't be the Fed that decides that. It should be the market. But once this bubble economy has to deal with a market rate of interest, the whole thing is going to implode because we've never had a recovery. We've just had a bubble.
Peter, you certainly are entitled to your opinion, and you've laid out the scenario that you think is going to occur. But why can't you just admit that, as we showed in the clip, you said the Fed could never raise rates, and the Fed did?
Yeah.
You were wrong.
Yeah, so other people thought they would raise rates a lot more than just a quarter point for all of 2018. Look, I knew it was possible that they could do it, and this is only, again, 25 basis points. And the only reason they did it was because they were afraid not to, because people were going to say that this must mean that they're nervous about the economy. So to show that they weren't nervous, they raised interest rates even though they didn't want to do it, and even though they are nervous. But I don't think this nullifies what I've been saying. And ultimately, if they have to go back to zero, if they have to go negative, if they have to launch QE4, then that validates everything I was saying. And this symbolic rate hike isn't going to mean anything.
Scott Nations.
Peter, for a long time, you've been quite a bull in gold. It's down $25 today. It's at its lowest level in years. What do you say to the people who bought it at $1,700 when you said buy it there? What do you say to the people who, again, bought it at $12.25 when you told them to buy it there? What do you tell them when it's now at $10.50?
Yeah, well, the same thing I've been telling people all along. Remember, I started telling people to buy gold when it was under $300 an ounce. So depending on when you first started listening to me, that depends on, on where your situation is. But I don't tell people to put all their money in gold. I tell people to put some of their money in gold, 5 to 10%. And as you get more money, and if the price of gold comes down, now you can add to it at a better price. I mean, I think my advice to have some of your money in gold is much better than almost everybody else's advice in this industry, which is to have none of your money in gold. And, you could look at history over the last 15 years. The stock market has been cut in half twice. And there are plenty of stocks that people have bought that were highly touted on your network that went down a lot more than the price of gold has gone down from its peak. So it's not
Peter,
that an asset can't go down, especially when so many people are so wrong about what they're perceiving. Remember, in the short run, right, markets are a voting machine. In the long run, it's a weighing machine.
Peter, let's
and
talk
right
about,
now, the votes that everything is
so
great
wrong.
and that the Fed is doing everything right outnumber the votes of the people who know that they've done everything wrong. But in the long run, the
Peter,
price
let's
of
talk
gold
about
is going to
being so
reflect all
wrong.
these mistakes.
Peter, you're doing a great job of filibustering, but let's talk about being so wrong, because when you told people to buy it at 1,700, you said it was on its way to 5,000. That sounds like so wrong to me.
So,
And the problem I've often
let me
had
ask
with
you a
what you
question,
said
Scott.
is you make 100 outlandish predictions. 99 of them are wrong.
No, I don't.
One of them sort of
No,
comes
I don't.
right.
And most
comes
of my
out
predictions,
right.
I've made a
Hey,
lot
Peter,
more
I let you
accurate
finish. Let
predictions
me
than you have.
finish.
But
Peter,
Scott,
I
let
let
me
you
ask you this.
finish. I let
Have
you talk.
Scott,
Let me finish. The problem is, Peter, that everybody that listens to you has lost all their money when they followed you with the first 99 predictions that were wrong, and when one sort of comes back around, they're broke. And the problem is that even when you're wrong, because you said that the Fed couldn't raise rates, wouldn't raise rates, and QE4 would be next, you can't, you're not admitting that you're wrong. And the worst decision that anybody can make when they're investing or trading is to not admit when they're wrong. That's how you get carried out.
Have you ever told somebody to buy a stock at 19 and it went to 17? Has that ever happened to you?
Peter, that's not
Or
what you did.
17
You
to
told
15.
people to buy it at 1,700 because it was going to 5,000, and it's now at 10.50 down 20.
You know what?
Now
But
down
it's
$26 on the day.
Scott, it's still going to go there. You know, you've never bought a stock that went down before it went up. Everything that you buy goes up immediately and never goes down. Excuse me?
So, Peter, you're never wrong. You weren't wrong when you said that QE4 was going to come before an interest rate increase.
Wait a
Peter,
minute, Scott,
this is why I think you're dangerous,
QE1,
because you're
2,
not
and 3.
willing
Did
to
you
admit
predict any of those?
when you're wrong. Traders and investors
I'm
are
not
wrong all
QE4
day,
is coming,
every day.
Scott.
Guys,
there
if
you
I can
go.
just-
See,
if I
that's
can
the
just-
problem.
If I could just jump in for a
You
moment.
didn't predict QE1, 2, or 3 either. Why don't you give me
Peter,
credit for that?
Peter, with a final question to you about gold prices that kind of wraps up this conversation that you're having. You're still taking the view that gold is going higher. As you mentioned, you're relating it to stocks that potentially they go down before they go up. How much lower do you think we could go before we start to rise again?
Well, again, I don't know. I don't think there's that much downside because I think most of this is already built into the price. Everybody has been anticipating the Fed was going to raise rates. In fact, they thought they would have raised them a lot more than 25 basis points by now. There are still people who think there's a lot more rate hikes coming. I still believe that's wrong. People are ignoring the inherent weakness in the U.S. economy and the fact that the Fed is going to be back to its old tricks. It only has one game plan for recession, and that's printing money. And when rates are at 25 basis points, there's not a lot of room to take them lower. You can go negative, but it's QE4 that they're going to be relying on. In fact, Janet Yellen said so herself in a press conference a couple of weeks ago. She was asked, what are you going to do if there was a recession in 2016? And her response was more quantitative easing because it worked so well last time. Well, it didn't work well last time. That's
Peter,
why we're going to be right back in recession in 2016.
Peter, we got to run. Just to recap your points there, you do think that we're going to see a recession that's going to trigger the Fed to take back the action with the rate hike, maybe take us into negative territory, and that QE4 could be on the table. We're going to hold you to these predictions. We always do. We'll have you back on soon.
Absolutely.
Meantime,
hold me to it.
Peter Schiff, ahead of the Fed meeting, I want to talk about gold prices. Peter, always great to have you on the program. I'm going to start out with an easy question. What do you think is going to happen with the Fed tomorrow?
Well, the Fed is probably going to continue the pretense that it can end the QE program, which it can't. It did QE2 because QE1 didn't work, and it did QE3 because QE2 didn't work. And, it can't end QE3 either. People think that the Fed can end this program because they believe that it worked. Well, it didn't work. In fact, the bubble economy that the Fed inflated is more dependent on quantitative easing now than ever before.
Okay, and you've come on the show before. You have called for QE4 or some other stage of this, even if we do get an end to QE3 tomorrow. What do you think that's going to look like? Could the Fed just keep interest rates low and keep the market propped up?
Well, it can only keep interest rates low for as long as people believe that the process is temporary. You see, what's keeping a bid in the dollar is the false belief that the Fed can actually end QE and raise interest rates, which it cannot do unless it's willing to let the economy go back into recession, which, of course, we need a recession because the economy needs to heal from all the QE, because the QE has actually weakened the structure of the economy. Every problem the Fed tried to solve, they've made worse. So the economy is in much worse shape today than it was before the Fed began with these programs. But in order to let the market unwind the imbalances, we're going to have a severe recession. We're going to have another financial crisis, unfortunately, worse than the one we had in 2008. I don't think the Fed has the stomach for that, which is why I think they're queuing up QE4.
All right, well, I don't think a lot of people have the stomach for it, but I do want to transition to gold prices specifically and really get right down to it with you. You were on the show just over 2 years ago today. Hard to believe that it's been that long ago. And this is what you had to say about gold. Then I want to get your reaction.
One day we're going to look back at 1700 with nostalgia. People are going to be shocked at how inexpensive gold was when it could be snapped up for such a bargain price. And it's not going to take too long, just in a few years. I mean, we're talking gold 5,000. That's not the ceiling. That might end up being the low end of the range that we're going to be into.
Go back to your price target on gold. What kind of time horizon are we looking at here?
Well, I think you're going to see a big move sometime in the next couple of years, because I think we're going to have a real fiscal cliff that we're going to go over.
Okay, Peter, we're lower now than we were then. 5,000 hasn't panned out. It's a couple of years later. If people bought gold on your recommendation, what would you tell them today?
We would keep buying. I mean, 1,700 I still think is going to look cheap compared to where the market is going to go. Obviously, it's going to take a little bit longer than I might have believed at that time, because so many people are still fooled, right? They still believe that what the Fed did worked. When they realize what a disaster it was, that the Fed is in a monetary roach motel, that an economy that lives by QE will die by QE, when it's QE infinity, when its rates are at zero forever, the price of gold is going to rise very rapidly. And I think the people who didn't buy it at 1,700, who might think they're smart now because it's at 1,250 and they don't own it, I think it'll go through 2,000 very quickly, and people will be very upset that they didn't buy gold at 1,700.
Well, let me ask you this, because you're very quick to criticize the Fed, but let's talk about what we have seen positive coming out of this period. Obviously, a lot of people have said this is a spiked punch bowl with the bond buying programs, but at the same time, we do have an earnings season right now that's panning out pretty well. Corporate profits are where they need to be. Earnings are growing. And you also have an economy that's growing as well. I mentioned it before with McNeil. We've got oil prices are lower. Consumers maybe going to take some of that extra money and put it back into the economy. Maybe, Peter, things aren't as bad as you think they are.
They're probably actually worse. You have to realize that whatever progress the Fed thinks has been achieved as a result of its monetary programs, all that progress is going to be reversed when the programs end. In fact, as they've tapered QE, you've already seen a lot of negative economic data come out. Most of the data that's come out over the past few months has surprised people to the downside. People are expecting better numbers than we are getting, and that is going to continue. And if the Fed actually ends QE tomorrow, then the data is going to continue to get worse. And of course, the stock market is going to come under more pressure. When you take away quantitative easing, you bring back a bear market in stocks, you create another bear market in real estate.
Right,
and we've already
Peter,
saw, just a week or two ago, Bullard came out as the stock market was going down, and he came out and suggested, well, maybe
dovish.
we should pause the taper.
Right.
Because the Fed blinked. The Fed knows if they take away the supports, the market will collapse.
It's interesting, though, Peter, because everybody knows potentially this end to QE is coming tomorrow, yet the market continues to rise today. And you even had the traders on just a couple of moments ago saying the little blip that we saw to the downside was just a temporary correction. So what is it that the market doesn't know today that all of a sudden it's going to know tomorrow when QE ends?
Well, just because it ends doesn't mean it ends for good. I mean, there was a pause between QE and QE2, and there was a pause between QE2 and QE3. In fact, they even threw in Operation Twist. So even if the Fed brings QE to an end tomorrow, doesn't mean they're not going to, resurrect it in a month or two.
It doesn't, and then we'll get a pause, and then if we get something else, the market will continue to go higher from there. Look, I'm not on the side of the Fed here. I want to be very clear about that. I'm just looking at sort of the argument that you're making and saying, really, what ends up happening to stocks? By all accounts, then they go higher.
Well, in nominal terms, yes, they are going to continue to move higher. I've always said that nominally, because of all the inflation that the Fed is creating, stock prices are going to trend higher. But in real terms, when people perceive the box the Fed is in, and again, that they didn't grow a real economy, they inflated a bubble that needs ever-increasing supplies of monetary air to keep growing, then when you see a big move up in the gold price, a big drop in the value of the dollar, I think that real U.S. stock prices, adjusted for real inflation or measured in gold, you're going to see a big decline in the price of stocks relative to gold, even if stock prices continue to trend upward in terms of rapidly depreciating U.S. dollars.
All right, Scott Nations wants in here. Scott.
I do indeed. Peter, I have a question because last time you and I were on together talking about gold, you said gold had some demand because dentists like to use it in dental work. That was May 22nd, and since then, gold is down 5%. 2 years ago, you said it was going to go to 5,000. Well, it's at about 1,200 right now. My question is, Peter, people watch us because they want to figure out how to invest. They want a little advice. When are you ever wrong? When are you ever wrong, and how do you ever learn if you're never wrong?
Well, first of all, right, I've been consistently telling people to buy gold since it was under $300
consistently
an ounce.
Wrong. And
so people who have been following my advice for the past 13 years and have bought gold are actually doing better than people who have just bought stocks. But I've also advised people to buy stocks. I haven't told people to only buy gold. I've told people to have gold as part of a portfolio. So you have to look at my
right now.
overall
You didn't
investment
say that the
strategy.
S&P was going to be at 5,000. You said gold was going to be at 5,000.
I think it's going to be at 5,000.
You said it 2 years ago. You said it'd be there now, and you're wrong. Are you ever wrong? And how do you learn as an investor if you never admit that you're wrong?
Look, I'm wrong a lot less often than almost everybody else that comes out on CNBC. I mean, all you do is parade people who are wrong. I mean, think of all the bulls who you brought out here on the stock market when the NASDAQ was at 5,000. Every time they come on, because the NASDAQ is still below 5,000. Do you tell them how wrong they were? Hey, you told people to buy stocks in 2000, and look, the NASDAQ is still lower. You know, I'm the only one that can talk about, and you guys put these time horizons on. I never came on the show and said, hey, I guarantee in 2 years gold's going to be 5,000. You always want to press me.
You're the one who said 2 years.
When is it going to be there? When is it going to be there? I don't know for sure. No, but you're asking me when. I don't know exactly when it's going to happen.
Then why did you say 2 years?
How long was I coming on CNBC talking about the housing bubble and you guys were laughing at me when I was forecasting the financial crisis? Go to YouTube. Why don't you look at Peter Schiff in 2005 and 2006 and 2007? I'm the only person who was on CNBC and got it right. Nobody else but me. Just go look at the tape.
So you're never wrong. Peter, I think that this is
now,
actually
I didn't say that.
Dangerous.
You said
this
that.
Is
but I will tell you this. I am wrong less often than every other guest that comes on this program, bar none. Yet you don't give other people a hassle for how often they're wrong. I generally get things right. And all you're doing is saying, hey, wait a minute. You said gold would be here at a certain date, and it's not there. You pressed me for a date, and I said, I don't know, a couple of years, 2 or 3 years. And so what? It hasn't happened yet. But if you look at the broad picture, I'm the only one that knew QE wouldn't work. In fact, I predicted the Fed would do QE before it even did QE1.
Gentlemen,
and so, while everybody thought it was going to work, I knew that it wouldn't, and the structure of the economy has been weakened dramatically by the Fed. The problem is you guys don't know that. You were so fooled by the phony economy before the financial crisis. You're just as fooled now. You had no idea what was wrong with the economy then. You don't know what's wrong with it now. That's why you think the Fed's cure worked. In fact, the Fed's cure has made the economy sicker.
Peter,
and when you get blindsided by this next crisis, hopefully you'll apologize to me because you didn't do it last time.
Phony economy right now or not, this is a market momentum shift that we're seeing. A dynamic to the upside. If you're a successful trader, you're definitely going to be able to ride this wave. And you're right about time horizons. They're very difficult to call. But at the same time, and as I told Bill Fleckenstein, and I stand by this, if you sat out while this market moved higher, you lost money. Inflation eroded your cash that was sitting in the bank. So it's really difficult to sit there and say it's a spiked punch bowl and that it's this, that, and the other thing. When the market is moving higher, people are making money.
Well, a lot of people are making money on paper, and they're going to lose it all back. But again, we're not sitting in cash. We're invested in things. We're invested in stocks. We're invested in precious metals. So I understand that cash is not going to work out. Bonds are not going to work out. People are going to lose a lot of purchasing power. You know, a lot of the jobs, in fact, almost all the jobs that have been created this year are being created for the elderly. I mean, people in their 60s and 70s have got jobs even though they don't want them because they're losing so much purchasing power because of all the inflation the Fed is creating to prop up the asset bubbles and to keep monetizing government debt. So, yeah, I mean, if you're holding cash, you're holding nothing. You know, you have to hold assets. But I think you have to recognize that if you're going to be in the stock markets, there are much better markets in the world to be invested in than in the U.S. because we have some real serious structural economic problems that we have yet to deal with because of the Fed. And because the Fed has delayed the day of reckoning so long, it's going to be that much more painful to deal with these problems.
Okay, and if you're talking about holding assets like gold, perhaps some people are, and they're waiting for it to move to 5,000, as you are suggesting it will. I personally will not be holding my breath until then. But Peter, thank you so much for coming on. We will have you on again soon to check in. Meantime, I want to know how to trade it, at least in the short term. 5,000 is not happening. Anthony Grisanti, what do you think?
You know, I don't think it's happening either, Jackie. And even with the QE, even if they start another QE program, Peter saw the results over the last QE program. Gold actually traded a lot lower. It didn't go any higher when they started, spiking the punch bowl. I'm going to use every kind of metaphor that he uses. But when they started doing that, gold actually headed lower at that point. So barring some sort of economic collapse that we saw in 07, which we're not going to see now, we're not going to see it. Sure, I could say the Jets are going to win another game this year, and I could be right about that. They have a 1 win right now, but they have 8 more games to play, so I could be right about that, and then I'll look like a genius. But, barring any economic collapse, gold is not going to get bid to 1,700, 1,800, 2,000. It's just not going to happen.
Okay, so what are the levels that you're trading gold right now?
It was actually Scott's trade, I believe, that he wanted to do.
Oh, pardon me, Scott, your trade.
Well, I'm trading gold, and you might have a tough time believing this because I disagree with Peter. I'm actually selling it. And why am I selling it? Well, because just as when stocks sold off, that was a buying opportunity. When stocks sold off, gold caught a bid, and that's a selling opportunity. So I want to sell gold. Specifically, I want to sell Dees gold at 12.31 even. It's gotten mushy right there, so we get some downside from there. The target is 12.05 even. We're not getting crazy here. We're not being overly greedy.
I'm with you on this, brother.
And our stop is fairly tight, 12.40 even.
Okay, all right, fair enough. Gentlemen, thank you so much. And my thanks to our guests today, McNeil Curry, and also Peter Schiff. It's always a lively conversation when he is on the program.
But I know you want to jump in.
Well, Peter, last year you were on our show and you said not only that they wouldn't raise rates, but they couldn't raise rates. Then they raised in December, and now our stock market is at all-time highs. Why are you right now when you were so egregiously wrong before?
Well, I wasn't egregiously wrong because remember, if you go back to late 2014,
you said they physically
let me finish. If you go back to late 2014, the consensus among most of the people that came on your show was that by the end of this year, the Fed will have raised interest rates between 6 and 8 times. I said they wouldn't raise them at all. And it's going to turn out that they raised them once. So I was far closer to being right by saying they wouldn't raise rates at all than all the other experts who were saying, 6 times, 7 times, 8 times. You go back and think of all the rate hikes that people thought were going to happen. I knew that the Fed couldn't raise rates. The fact that they did one trivial quarter-point rate hike and then backtracked and took them all off the table proves that I was right, because they said they couldn't raise interest rates without crushing the markets. They raised interest rates. The markets got crushed, and the only reason the markets rallied back was because they stopped raising interest rates, which is exactly what I said.
Peter, you said they couldn't. They did.
The market
couldn't. Actually responded.
They raised rates once. The markets collapsed, and then they stopped doing it.
You asked me to let you finish, so you let me finish. You said they couldn't raise rates. They raised last December. Between the time that they raised and the end of the year, things actually went really well. If there was a problem between the first of the year in January and February 11th, it had nothing to do with the Fed. It had to do with the Chinese instituting these really ill-conceived, poorly thought out, poorly conceived, ill-considered circuit breakers. And then once those left, once they canceled those, our market has rallied beautifully. So you said they wouldn't raise rates. You said they couldn't raise rates. They did, and our market is at all-time highs. So
yes,
you can
because they didn't raise them, because they stopped. Look, this is what's ridiculous. How many people came on CNBC and said, the Fed is going to raise the rates 3 or 4 times in 2015, 3 or 4 times in 2016? Everybody was off by a mile. I was the closest one who have come on your network in the last few years. Nobody got closer to me than how many rate hikes we would have. I said 0, and we got 1. Everybody else was so far out of the park. The fact that they stopped at 1 proves exactly what I was trying to say, that they couldn't raise rates, and the fact they thought that they backed themselves into a corner because they waited until December. There were people who thought they were going to raise rates in March, in June, in September. They were wrong all year. I was the only one that was right. I kept saying they won't raise, they won't raise, they won't raise, and finally, to try to save some credibility, they did a trial balloon. They did a quarter-point face-saving rate hike. The markets fell apart, and then they immediately backtracked, and that's it. And I still believe, and I said this in December of last year, that the next move by the Fed is going to be a cut in rates. And so we'll see what the next move is, because I still think the next thing the Fed does is cut rates, not raise them again.
Peter, I have one more question, because let me ask one more question, Courtney, because Peter says he's the most prescient guy on CNBC. Peter, my question then is...
Well, that's a low bar. That's a low bar, but yeah, probably.
Hang on. The Euro-Pacific Fixed Income Mutual Fund is 300 basis points behind, underperforming its benchmark every year since its inception. 300 basis points. That's double what somebody would get in the 10-year.
Okay, hold on.
By putting,
and here's why.
If you are so prescient, then how come your performance is so brutally bad?
Okay, so if you look at my value fund, I'm beating my benchmark by 40% year to date. It's the number one fund out of like 400 or 500 funds. So I'll tell you why my bond fund is underperforming. Because I don't own any bonds. It's a bond fund that has no bonds because I don't want to participate in the bond bubble. So when the bond bubble bursts, my bond fund is going to be number one. So the reason it's lagging is because I don't actually own any bonds. All I have is very short-term, debt in foreign currencies. But if you look at my equity fund, my gold fund was the number. Hold on. Look, my gold fund was the number one fund this year. My value fund, my dividend payers fund is, I think, number one or number two mutual fund in its category this year. So you're picking the one fund that's lagging, and you're ignoring all the other funds that are number one. And I tell you, the only reason it's lagging is because I don't want to expose my clients to the biggest bubble ever in the bond market. And when the bond bubble collapses and everybody else loses money, the people in my funds are going to be sitting pretty, or at least
all right,
my
thank you so
fund.
much, Peter. We really do appreciate you joining us. A lively conversation as always. We do appreciate it and understand your viewpoint.
But you should put up the graph. Put up the graph of all my funds that are rated number one.
Thank you so much, Peter. Really do appreciate. We appreciate you coming on, and we will look into your performance. We do appreciate it. Peter Schiff there of Euro Pacific Capital.
5 crashes. So I guess you've got a 6th one here. How do you define a crash? Should we worry about these kind of labels and stuff?
Well, it's actually a little bit subjective. I think there's no doubt now that this qualifies as a crash. It's kinetic. It induces a bunch of fear. It is actually largely psychological at some point when we get to the point to define it, to call it a crash. But baby, we are there.
Yeah. The
job of responding to what happened in 1929. And that's why that dragged on forever.
All right, so here's where we get to the crux of it, Scott, which is the Fed's already been active for 10 years. And isn't that kind of the specifically nuanced point about this? I know that there's a virus that is lethal, that is scary, that is threatening, that is very real. We know the economic response is real. But the cause, as you point out actually in your book, a lot of these crashes come from non-financial events. And if the Fed's been active this entire time and it's a virus that's causing it, why would they create the bottom?
Oliver, one of the reasons I wanted to write the book was that I enjoy reading a little bit about history, particularly financial history. I've been in the markets for a long time. And you read about some of these crashes and you see certain things line up. You see things repeat themselves. One is a non-financial catalyst. One is a non-financial catalyst. All of them have one of these. For example, in 1907, panic in 1907, it was the 1906 San Francisco earthquake. Coronavirus is absolutely the non-financial catalyst, but that's not sufficient. It's necessary, it's not sufficient.
Okay.
The other thing is a bubble in equity prices.
Hold on, what do you mean by this bullet point is necessary but not efficient?
Sufficient. It's not
sufficient, sorry. Necessary but not sufficient.
Right, we have to have some sort of catalyst that really starts the race to the bottom.
Okay.
So everybody is lined up all of the phenomenon are lined up, and it's really this catalyst.
And a bubble's got to be
go.
one of those phenomenon you're saying to be lined up.
Absolutely.
Okay.
Yes, bubble is one of them, and there's usually also some sort of financial contraption that injects leverage. But the bubble is absolutely necessary, and more times than not, the bubble has been inflated by the Fed being too low for too long. Nobody has been a bigger critic of the Federal Reserve over the past 2 or 3 years than myself. Why? Because they're keeping rates too low for too long. They've inflated a bubble, and that's why we have a crash. Some sort of financial contraption that injects leverage. But the bubble is absolutely necessary, and more times than not, the bubble has been inflated by the Fed being too low for too long. Nobody has been a bigger critic of the Federal Reserve over the past 2 or 3 years than myself. Why? Because they're keeping rates too low for too long. They've inflated a bubble, and that's why we have a crash.
Okay, well, here's where I got to jump in because there's going to be a lot of people that want to dispute this, okay?
Okay.
And as the way I've covered it the last year, I believe those last 3 cuts were a little bit harder to justify. Now, the argument that I would say is stocks in the past have gotten way more bubbly than they did this time around. But what's the counter argument there? Is it that bonds were also moving with such serious intensity over the past year?
Well, no, I would say that valuations in the stock market got very close to all-time highs, if not matching all-time highs, which says we were at a bubble.
We didn't hit .com, but we got the highest for this bull market.
There you go. And the reason that happens is because rates are too low for too long, and there's this desperate scramble for yield. And people look at the S&P at a dividend yield of 2%, and they think, hey, that's actually not that bad. Let me go ahead and bid it up. And that's what happens. And the Federal Reserve was on this ridiculous march to try and get inflation from 1.5% to 2%. An inconsequential difference, and this is what happens.
Okay. So when the other crumble last year if the Fed didn't step in?
Well, how about this? If the S&P had started the year at 2,500 instead of above 3,000, if it started the year at 2,500 with a normalized Fed funds regime, we would not be having a crash right now. Coronavirus would certainly be a problem.
Shut down the economy, though, right now. We wouldn't crash based on that?
No, we would not have a crash. It would certainly be an ugly sell-off, but we wouldn't have the sort of demoralizing crash that we're having right now.
It's measured by what, speed?
Speed, magnitude, but also, again, psychology. Because what's happening right now is people are terrified, not just of the coronavirus, appropriately so, they're terrified of the market right now. And so that's the difference. If the Federal Reserve had normalized interest rates years ago and the S&P had only gotten to 2,600 instead of 3,400, then we wouldn't be having a crash right now.
Okay, now I want to get even more specific.
Haggard song that is appropriate here. And it goes, I only fall when I'm on the mountain.
Okay.
Well, the stock market only crashes when it's in a bubble. If it's valued appropriately and it comes down a little bit more because of something like Corona, then you know what? It's sustainable, it's understandable, it's reasonable, and people aren't terrified of the market.
All right, we've got.
I think what's going to happen is when the Fed goes back to zero, which is what they're going to do, they're not just going to cut 25, 50 basis points. They're going back to zero, but there's not a lot of room between where we are now and zero.
We're at 2.25 to 2.5.
So what the real stimulus is going to be is QE4, which is going to be bigger than the first 3 rounds combined.
Wait, is that your prediction?
Oh, yes.
You say, okay, articulate it here.
Well, the Fed's going to go back to QE. I mean, they're going to do whatever they can to try to stop the bear market and to try to prevent the recession. But they are going to fail. They're going to make it worse this time.
I want to congratulate the Federal Reserve. For starters, they've lowered the Fed rate from what it was, which was 1 to 1.25, and it's been lowered down to 0 to 0.25 or 0.25. So it's 0 to 0.25. That's a big difference. It's quite a bit, about a point. And in addition, very importantly, the Federal Reserve is going to be purchasing $500 billion of treasuries and $200 billion of mortgage-backed securities, and that number can increase. But they're going to start with that, and that's really good news. It's really great for our country. It's something that we're very happy. I have to say this. I'm very happy. And they did it in one step. They didn't do it in 4 steps over a long period of time. They did it in one step. And I think that people in the market should be very thrilled. And that brings us, we're the strongest country in the world by far, financially and every other way. And that brings us in line with what other countries are. they actually have negative rates. But look, we got it down to potentially zero. So that's a big step, and I'm very happy they did it.